Investors, I did it once again. This time, I've decided to invest $1,000. Not $100, not even $10,000, but exactly $1,000 into one of the newest high-yield weekly dividend ETFs on the market, ULTY, the Ultra Option Income Strategy ETF by YieldMax. In this deep dive breakdown, I'll walk you through the exact moment I bought $999 worth of ULTY live, explain my income portfolio strategy, and give you a complete review of what makes ULTY a powerful yet risky addition to a high-income ETF portfolio. Setting the stage, my portfolio context. To start, let me give you some background. I maintain two separate portfolios that serve very different purposes. First, there's my long-term wealth-building portfolio. This is the conservative core of my financial future, mostly managed through Vanguard. It consists of broad market ETFs like VOO, QQQM, VTI, SCHG, and dividend growers like DGRO and SCHD. Across my taxable brokerage account, Roth IRA, and 401k, this long-term portfolio now totals around $200,000. This is where I prioritize growth and tax efficiency. Dividends are modest, but that's by design. It's all about long-term appreciation. Then we have the second portfolio, my income-only high-yield ETF experiment. Think of this as my fun portfolio. It's smaller, currently around $2,000 in value, and much riskier. Here, I try to build consistent income through covered call ETFs and other yield-maximizing strategies. The first holding in this portfolio was MSTY, MicroStrategy Covered Call ETF, which has done quite well. Over 18 days, I've seen a 3% gain, and the average share price sits at $20.60. Solid income flow, nice appreciation. Now ULTY joins the lineup. I invested $999 into ULTY and picked up about 158.94 shares at a price of $6.29 per share. I purposely kept it under $1,000 to avoid rounding errors during the purchase. I'm 24 years old and a firm believer in ETFs. My total ETF portfolio value has now reached around $28,000, and I consistently invest $6,000 a month. This month, I hit a personal milestone by investing $24,000 into ETFs alone. I'm not earning six figures yet, but I've committed to building wealth through discipline, research, and consistency. Over time, I've also interviewed the minds behind many ETF issuers, CEOs and CIOs from YieldMax, Vista Shares, Neos, Simplify, Defiance, and upcoming interviews with Granite Shares, Roundhill, and Rex Shares. These conversations have given me insights into how these products are built, why they exist, and where they might fit into an investor's strategy. ULTY is unique because it's designed for weekly income, not monthly, not quarterly. That's a major selling point. The ETF generates income through covered call strategies on a diversified basket of high volatility stocks. Now, instead of betting on a single name like Tesla, TSLE, or Coinbase, Xiani, ULTY spreads risk across 15 to 30 different names. This creates diversification, which theoretically lowers risk without sacrificing income. It also helps avoid the performance whiplash you sometimes get with single stock covered call ETFs. The strategy is actively managed, meaning the portfolio team constantly adjusts holdings based on volatility levels. That's important. High implied volatility equals higher premiums. Higher premiums equal more weekly cash in your pocket. But let's be clear, ULTY is not a growth ETF. It's not going to 5x your money. If you want growth, you're better off with VTI, SCHG, or individual growth stocks. But if you want regular cash flow to reinvest, pay bills, or even supplement your income, ULTY may be worth a serious look. As appealing as the 75% yield sounds, there are real risks. Capped upside. Because ULTY writes covered calls, it limits your gains. If the underlying stock spikes, you don't benefit beyond the strike price. Market risk. If the stocks in the portfolio drop, so does ULTY's share price. Income won't fully shield you from losses. Tax inefficiency. The distributions are taxed as ordinary income, not qualified dividends. So this ETF is best held in tax-advantaged accounts like a Roth IRA or 401k. High fees. A 1.3% expense ratio is steep. The goal is for the income to outweigh that cost, but it's something to watch. ULTY's sub-advisor selects between 15 and 30 volatile stocks. This isn't just for kicks. Volatility is key. High volatility names produce larger option premiums. The management team actively evaluates each stock and adjusts the covered call strategy accordingly. They can increase exposure, reduce it, or eliminate a name altogether if the volatility profile no longer fits. This kind of active management helps ULTY avoid dividend instability and maintain strong performance during volatile market conditions. Primary goal: deliver high weekly income. Secondary goal: capture some of the upside from underlying stocks. It's important to understand that upside is limited due to the covered call structure. If you're okay with that trade-off in favor of weekly income, ULTY could fit nicely in your portfolio. Covered calls involve holding a stock and selling call options on it, but ULTY takes a synthetic approach using long calls and short puts to mimic ownership without holding the actual shares. Once that exposure is established, they write sell call options to collect premiums. You get high weekly income from the premiums. You cap your upside because gains above the strike price go to the option buyer. You're less tax efficient since options premiums are ordinary income. ULTY's top holdings are some of the most volatile names in the market: Reddit, RDDT, Circle Internet Financial, Robinhood, Hood, Tesla, TSLA, Hims & Hers Health, Upstart Nvidia, NVDA, Palantir, PLTR. These are fast-moving high-beta stocks, perfect for option selling. What's impressive is that ULTY keeps the weight fairly balanced. No single holding dominates the fund, which reduces risk while still harvesting high premiums. This is where ULTY truly shines. Yield. Estimated at 75% annually. Yes, 75%. That's not a typo. Expense ratio 1.3%. Payout frequency weekly like clockwork. Compare this to monthly or quarterly dividend ETFs like VYM or SCHD, and you can see why ULTY is attractive for income-focused investors. Plus, unlike single-name YieldMax ETFs like MSTY or PLT, ULTY's income stream is more stable. Let's talk numbers. 1 year total return, tilde 14%. Respectable, especially given the weekly distributions. 1 month performance, plus 7.92%, outperforming MSTY, PLTY, and even TSLE during the same period. This outperformance is likely due to the broader diversification and smart volatility targeting by the fund managers. The fact that ULTY is now beating out other popular YieldMax products says something about the power of diversification even within the high-income ETF space. Final verdict: pros and cons. Pros: weekly income, not monthly, not quarterly, weekly. Diversified across 15-30 stocks. Active management focused on volatility. Smoother and more consistent income than MSTY or PLTY. Safer than single stock covered call ETFs. Cons: high expense ratio, 1.3%. Tax inefficient in non-retirement accounts. Capped upside, so you miss gains if markets rip slightly lower yield than the most aggressive YieldMax single stock ETFs. I'm giving ULTY a 9.5 out of 10. It's one of the best income-focused ETFs I've come across, especially if your goal is cash flow and consistency. It gives you diversification, active oversight, high yield, and weekly income without putting all your eggs in one basket. Right now, my income portfolio consists of MSTY and ULTY. Next up, I'm thinking about adding PLTY, Palantir covered call, or maybe even MSTY, MicroStrategy covered call without leverage. I'll continue this experiment, adding $1,000 lump sums into each ETF and reporting back on the income generated, performance, and risks. If you're looking to start an income portfolio or want to explore an ETF that pays every single week, ULTY is a name worth watching. Thanks for following along. Drop a comment letting me know which ETF I should invest in next. And as always, stay consistent, stay curious, and keep building. Peace.